Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we're going to go over just the kind of whipsaw action on the Bitcoin chart, as well as in many of these crypto assets. We also see that in the stock market, where today, of course, was a bit of a red day overall. But let's just quickly jump to the charts. I do want to address some macro this episode. So we'll get that at the back of the episode. I will just address the Bitcoin chart first. But what I want to touch on in the macro is basically this chart, which I've been seeing pop up on a lot of crypto YouTubers' channels. And I gotta just laugh at some of these guys. They're totally unqualified to be talking about macro, and then they find one chart on Twitter and they just they just keep running with it. And so I've seen it on at least four major crypto YouTube channels, and they are just dead wrong about how they're interpreting this. Actually, I think it was five YouTubers now that I think about it. I almost forgot about one. But guys, just based on Bitcoin, it's pretty much doing exactly what I said it would be doing the other day. A couple days ago, I was showing you how we were having this kind of hell line. We were consolidating underneath the hell line. And yeah, of course, price action can pop up or down. I mentioned that there's likely to be a limit on this move if we do throw on our EMAs. You can see that on the 4 hour, we have the 200 SMA and the 200 EMA just colliding, right? Just colliding right overhead, right at that spot where I said likely we're going to be limited around 17,500, maybe 18,000 at most, where we have a pretty strong 300 EMA up here. But of course, these 200s are very strong on the 4 hour there. And what that looks like on the daily is these 35s coming to crash down on us. Now on the daily, we are being supported by my hell line here, and of course, we are getting a little bit of a bounce. So on the higher time frames, I'm not, or I should say the mid time frames, I'm not really bearish or anything. Of course, we are having pullbacks on the shorter time frames, but we have to remember that we do have some support on the daily, and nothing's really broken yet, guys. We basically bumped our head with this wick on the 35 on the daily. We bumped our head on the 200. Very tough resistance to break through on the 4 hour, and so we're just doing a further check back, okay? And this could actually portend a deeper pullback than what we've experienced so far. So, if we lose around 17,000, that's going to, give you an idea of where we are. You can see that we could easily flip above the 20 EMA and then maybe even rise again to, 17,300-ish or whatnot. Or we could dip below this kind of a 16,900 area, the $16,800 area, and then we could dip to 16,600 or maybe even lower, right? But we do have some support below us. Um, these could be just a kind of staged checkbacks while this 35 crossing, plays out. And since that's going to be a bullish cross, I have to tell you, this is another Alpha 9 knockout. Okay, I say I call it the Alpha 9 knockout because usually we can see it beginning with the 9. Okay, so what we see over here are the 9s crossing bullishly. And what does that do to us? It gives us, it knocks us out temporarily until we get that pop. Here we have an Alpha 9 knockout, but it's the 20 and the 21 knocked out. See right here, right underneath the cross. Boom, right? And now we have another one. It's the 35 and the 35. And again, guys, this is just like my trademark kind of a move here. I promised you guys that I would always let you know whenever I see one of these popping up, whenever we review the EMAs. And so I'm saying, like, look, there's an Alpha 9 knockout coming out, okay? I warned you about this one, warned you about this one, and now I'm warning you about this one. So we also have this deeper one up here with the 89s, but you guys have to understand that this is not a bullish crossing. This is actually, if that does cross, that's a bearish crossing. So that's something to address in a totally different way. And most likely this is going to skim if this continues to pump. So we'll just watch to see what these other EMAs are doing. But over on the 4 hour, you can see that we are just in this wave structure. We are just like picking up one EMA after another. And so because this is the lower time frames, we can kind of see this kind of accelerated progress to bullishness. And now we're getting into that area, which is really hard to break. And so there's either going to have to be a big pump, or we're going to have to collect some energy and then try again, or this thing could just completely reject us from this move, right? If Bitcoin just happens to be that weak because of all of the FUD and people, buyers just don't want to step in because they're just so scared, right? So basically, that's what we're looking at with the EMAs there. Now, if I do go ahead and throw on some of these other kind of trademark things that I've got going on here. Well, first of all, let's take a look at the formation that we had playing out. Of course, we had that indecision wedge coming off of kind of this kind of bull flag, bull pennant type, move here, which did suggest that we could get a pump. This doesn't have to play out that way, but if you just want to look at it from a patterns perspective, we didn't really do anything terrible. We just popped up, and now we're coming back to check out to retest the breakout. And who knows, we could continue on our way, right? Just get above this hell line here and just continue to go. If we do continue to move the way that we have in the past, however, you can see we also had this type of bullish pennant. We also had this type of bullish pennant where here's the flagpole, here's the flagpole, broke out, didn't check, didn't pop back up, right? Broke out, didn't pop back up. We just continued to go down, continued to go down. So, that could happen again, check back, and then we could just continue to go down. So this is the super critical level where we're at, okay? We've just seen this pattern time and time and time again, and there's also kind of one that's just really distorted over here, but same exact deal. So we really do have this waveform that's being printed on Bitcoin, which is why I'm using the 4 hour, because you can see it with this hell line, just how beautiful that sine wave is playing out. And yes, this one has a little bit of a waver in it because of, that bit of extra pop that's there where you only see a little bit here at the end of these triangles. This one had a nice juicy one, which was a great move. And we did capture that. The Alpha Fam over here, again, guys, like we're just absolutely killing it with our strategies. If I throw on the momentum pools, I was bearish. I thought we were going to go down because I was saying like we have a similar toppy formation as this one, and it looks like we're just doing it again, right? And that could still play out to the downside. But I did set the momentum pools out there to show you that over the next 2 to 5 days from when I made this, I believe it was on Friday or Saturday, that we would have to get on top of this 2 to 5 day projection over here, and we just weren't able to do that. Okay, so. Um, we are just swimming around in the 2 to 5 day projection, which essentially is continuing out another day. And what we did do is get on top of the momentum pool over here. We popped up, we captured all of that bullish momentum, and then we rode it up. I mentioned that there would be a limit based upon those EMAs. We bumped our head on the EMAs, came back to retest the next day's momentum pool, and also testing this formation, and we're just swimming around there. Now we're beginning the new day on top of the momentum pool, this alpha momentum pool here. I can just delete this 2 to 5 day projection. We're on top of it right here, and we could continue to pump, or we can just dump back in the pool, okay? But the point is, we're not swimming and popping out of it, right? Where you see how we have a nice pop when we do that. We're just kind of sitting on top of it. So something's a bit um, repressed on this momentum, and it looks a bit like this one over here. You see where we were swimming around, we popped up, got pushed down by whatever, one of those Alpha 9 knockouts probably, made a second go and just kind of got repressed there. And so we could easily dump back down into this pool. I don't see anything just like pushing us up, right? Like there was a lot of energy in this area right here. This is just a really indecision kind of candle. And we do have that waveform that does suggest our trajectory. And so, we really do need candles up here around 17,200, 17,300 for us to continue to go. But we did capture the momentum off of this momentum pool. And, there was no reason to really be bearish unless we broke back into the pool or, and we didn't really do that. You see, this was the level that I gave you in the last episode, I believe, and we just checked back to it perfectly. So, even taking this trade is just a break even if you let it ride so far. So again, like there's some beauty to these alpha momentum pools, and I'll show you what it looked like for the levels that we had out there. And just turn off these pools, and you can see that the levels that I had for a bullishness and a solid bullishness. And look right here, right as soon as we got above the bullishness, boom, like right to the next level. As soon as we got over the solid bullish, boom, all the way up there until we hit our head on that 35. And then of course we got rejected by the Alpha 9 knockout. And look, we tested the neutral level, retested the bullish, got rejected by the bullish, came back down between neutral and a bullish-ish, where essentially the market is just deciding, well, we like this trend, but we're not fully committed to it yet, right? The buyers just aren't able to break through the bears, the bear wall. So, that makes it a lower high essentially, if this continues to play out, and then that could portend potentially a downtrend where you see this little wick is lower than that one. It's either a double bottom or it's slightly lower, and then that's going to be a lower high on this 4 hour. And so it's just very easy for us to break down into these levels. Now I do have an update for that. These were the previous levels. So let's go ahead and take a look at the new levels. Because of this huge pump, we did get a little bit more spacing in our momentum here. And so I would say that we would have to be solidly bullish. We do need to get above 17,500 still. We have to break essentially those EMA areas. Um, get above those 200s, and just more likely that they're gonna, if this crosses, it's more likely to push us down than pull us up. But you never know. Sometimes something weird happens, and again, you can't trade off of just one indicator, right? You can't trade off of one setup. You have to have multiple confluences. And so, if we are bullish, then there's no reason to really doubt our bullishness, because you've seen how price action can just pop off of these lines or just drop below them, right? Should it break under. And right now, my estimated neutral level is 16,970, and we're just sitting right on top of it. What does that suggest? If we do get rejected here and break underneath 16,970, there's a good chance that we go swimming down here, even as low as 16,670. Okay. And then after that level, I'm going to be uh, changing to just bearish. Okay. So obviously it's bearish to drop like that, but I'll be bearish officially. And then below 16,580, I'll just be solidly bearish, right? Like this is open-minded to bearishness. And on the flip side, above 17,225, I will be open-minded to bullishness. And above 17,500, obviously, I think that we're just continuing, to be honest. Let's see here. We will lose all of our momentum around 15,530 for the day. So I don't think we're going to drop down there in one fell swoop. Probably we get some support in this area, right? And we maybe try again. If even if this thing knocks us down, maybe we try again. If we just cut straight through this level, I would just be pretty shocked, to be honest. Okay. Let's go ahead and just throw on the daily just to see what that might be looking like at these lower levels. Yeah, you have the 20 simple moving average right there, right in my bearish zone. So, just tagging back to that 20 simple moving average, that wouldn't be a big deal. Obviously it's not the best look. You don't want to close the day down there. But if we just tagged that and then came back up, that wouldn't be too terrible. It'd just be something like this, right? Something like this. Scary, but recoverable, right? Just grabbing some liquidity and whatnot. Let's see here. Go to the 4-day. All right, I think I've covered Bitcoin enough. Let's go ahead and get to the macro because I do want to just show you what's going on with the stock market. And in the stock market, you can see that we do have this bull trend, which of course is in a bearish pattern of this rising wedge. It's a pretty obvious one. You have the same rising wedge on NASDAQ, but it's just much sloppier. It's a much weaker one. Whereas the S&P 500 has, tagged its macro downtrend. The NASDAQ hasn't yet. And so does this suggest that we have more fuel in this system to pump up and touch that line? I don't know, because we didn't grab it here either. I mean, I'm just assuming that this max goes along with this one because this was a little bit more bearish, and maybe tech is just a little bit more bearish right now. We look at the S&P 500, and I can use an analogy to understand why I might connect things this way, and you can see it connects absolutely perfectly, right? So I don't think that Nasdaq is being bullish. I think Nasdaq is being repressed because it's the more risky assets compared to the S&P 500. And so whether we look at log or whether we look at linear, either way, the S&P 500 has maxed out to its supply line on this macro downtrend, which does suggest that it could break down at any time. Now, the area that we're looking at for where it could break down is that area associated with the 20 on the monthly. Oops, monthly. And of course, we do need to consolidate in that area in order to avoid the kiss of death, right? So has the kiss of death been, avoided? It's not official yet, right? This could just end up being just kind of a wick. But, this month, this last month did close above the 21 there. And while we have the 21 SMA, we did close above the 21 EMA. So we're still in a little bit of this no man's land, and we could actually pump all the way up to like this 4,200, and that wouldn't be too shocking, and then get rejected and just kind of break out of this downtrend. And this could all be just a market fake out, and maybe we really do have a kiss of death. It's just this is just acting more as a region, and then we could potentially see significantly lower levels, maybe in the lower 3000s down here, maybe stopping around, along the way down here. But just if we look at the bear pattern, the rising wedge, you can see that this would have a measured move that would give us a higher low. So somewhere around 3,700, just kind of like retesting this area, that would be based upon the rising wedge, okay? And so if we do break to the downside, I'm not expecting this thing to put in a lower low right away. I would expect it to try to put in a higher low before anything else. And I just don't know what would be the catalyst to bring us lower. Okay, if the Fed is pivoting, in the sense that it's slowing down rates, not officially pivoting to lower rates, but it's just pivoting to slowing down rates, then I wouldn't expect a final capitulation of the market yet. I would just expect the market to pull back and have normal behavior. And again, guys, like, we have to understand that we aren't pivoting. Okay, so when all these like YouTubers and these different people in crypto who don't know anything about macro are showing you these charts suggesting that we're going to drop 50% on the S&P 500 just because the Fed is starting to increase rates at a slower pace or not be as intense with the rate increases that they have. That's not what's going on here. They shouldn't be showing you this chart right now, or they shouldn't be kind of emphasizing it right now, because it's unlikely that we're just going to suddenly get a 50% drop. Now, it is possible the Fed could say that something got broken and they need to actually lower rates. If they lowered rates, then I guarantee you the market's going to freak out and maybe that kiss of death occurs. But we're basically just slowing rate hikes right now. We're not actually pivoting. So you have to define pivot carefully, right? So just to re-emphasize this for you guys, pivot isn't the slowing of rates or even a temporary pause, right? Pivot means to reverse course and actually lower rates. So yes, if the Fed pivots, we're probably going to have a mega crash that will, basically melt faces and cut the price of BTC in half, maybe, and it's going to be essentially the second half of this thing, you know, capitulating down where you see that kind of a 50% drop, right? But, if the Fed is merely slowing how fast it increases rates, then the market can actually return to the previous all-time high, believe it or not. So if you hear what I'm saying, the market, if we do get that breakout and the Fed is merely slowing the rate at which it increases rates, then we could actually see our previous all-time high in the market. And that's why these kind of scary graphics that show us falling 50% down don't really make sense to be emphasizing. They just don't understand how this works. And again, like four major YouTubers are pushing, five actually, are pushing that concept on, 100,000 different viewers, and it's just going to create a lot of confusion for people who look at that chart. They may think that we're going to go to $10,000 Bitcoin right now, when honestly we could be on the verge of a bull run. Okay, I mean, not a bull market, but just a run. And that's not what I think is going to happen. I'm very neutral on this one. I'm not a perma bear. I'm not a perma bull. And I don't really have a thesis that we're going to just, create a, go back to our previous all time high or anything. I don't believe that. But do I think that we could get a run out of this? Possibly. Yeah, if we don't get any more bad news, then I think that we could get a run out of this. And then maybe in spring, when we've had a time to absorb all the information about the recession, then maybe we do a check back and test our previous lows and maybe even push down lower, depending on how bad the recession is. Or if the Fed starts to increase rates again, then maybe, something pushes us lower, or if the Fed pivots, ironically, and starts lowering rates, then maybe we could have that kind of really serious capitulation crash. So I do think this is all going to be left open to 2023. Okay, so again, I just want to emphasize this because it's a macro Monday here. We do have the potential to create a double top on the S&P 500. And yeah, the markets can be suppressed for a while because the Fed can continue to increase rates, right? And so if we look at the Dow Jones Industrial, not sure if I have that up here, but let's get the Dow Jones Industrial. You can see that it's already broken out of its downtrend quite significantly. And what does this portend? This portends, oh wow, it hit my first target. Nice. I didn't even know that. I should have bought there. But guys, yeah, so you can see that it is breaking out of here. And because these are the really safe stocks, right? These are the really safe stocks. And so it's super bullish in a very risky environment. Whereas, um, by contrast, the NASDAQ is underperforming. You see, it hasn't reached its downtrend yet. It's just well below it. And then the average, right? The S&P 500 is just meeting its downtrend. We're just basically right there. Go by log, you can see it this way. You go by linear. On both charts, the log and the linear, it's absolutely met its downtrend. Does that suggest it's time for a pullback soon? Yeah, but it doesn't suggest that it's time for a market capitulation. And we could still get a little bit more of a pump out of this wedge. If we do zoom in, you can see we're at technical support right here. And on the daily, if we pump through this 200, right, we could get a nice kind of spike up here, just like we did right here. So, we broke that 200 once already. We could break it again, and then we get above the 200. You know, with the Dow Jones leading the way, then the S&P might be able to follow. Maybe it's not going to be as robust as the Dow Jones, and then the Nasdaq could follow. Maybe it's not going to be as robust as the S&P 500, and crypto could also follow, and maybe crypto doesn't get a new all-time high or anything, but maybe it does get some type of rally, right? Because it's the riskiest asset. And all of this might just go out the window until 2023, maybe even 2024, we don't know. So I just want to have a talk about that kind of a macro. The only reason the Fed is going to pivot is if the economy breaks, guys. Okay, so that's why we have major crashes after a pivot, right? Almost every time. I mean, think about it. The Fed, the Fed would never pivot unless something has broken. Why would the Fed pivot? Right? The logic is obvious. The Fed wants higher rates to reduce inflation, right? And since the government is always printing more than it can afford, the economy is always inflating, right? So the Fed has its job cut out for it. It has to keep increasing rates. It wants to keep increasing rates. It wants to increase rates as much as the economy can accept, right? Because the government is constantly printing more money, and constantly causing more inflation. So the Fed has to constantly be vigilant against inflation. I hope that makes sense, right? So the Fed would prefer to continuously increase interest rates to fight the continuous inflation caused by governments. Therefore, if they're pivoting, i.e., they're lowering rates, that goes contrary to what they want to do. And it means that something very, very, very important got broken. And the market will know that. That's why it crashes, right? That's why it has this type of a crash. That's why, that tends to be signaled by a kiss of death. And we avoided that. We avoided that this year. It looks like we're going to avoid that. But what you can see, for example, back here in the 2000s, right, the early 2000s, you can see that we had a technical double top before we had the next major drop, okay? And also back here, right, in the pre 1970s, we also had a higher high even before we had this major drop. So we can get a drop and then we can actually come back up and make a double top before having an even more serious drop later on. What does that mean? That means that yes, it is possible to do something like this. Okay? And nobody's going to like it back here. But it's called kicking the can down the road, right? So the problem didn't really get solved yet. They've just not known how to handle it, or they went so far in trying to handle it that they broke something and then the market freaks out. Okay. So we still have a lot of room to break down. Let's say something that does get broken. We don't have much more time, but let's just say something that does get broken. We still have a lot of room to come down here. Okay? Like we've done this type of thing before. We could do it again, right? So the bottom may not be in. That's true, okay? Like we could still see something extremely, extremely scary happen. But I just want to emphasize it doesn't have to happen right now. And if we look again at the Dow Jones Industrial, all right, I mean, it's basically showing us the way. It almost wants to make a double top already. It doesn't mean that something can't get broken later on and then it comes back down. Does a double bottom or goes lower and finds, truer support, or makes a higher low, and then comes back down. But could we continue a rally? Yeah, it's on the table right now. So don't be a perm bear. That's my key message to you. Don't be a perm bear. But we do have to understand that we do have high risk on the other indices. Now, the indices are, they're not synced up anymore. They used to be synced up, but now they're not synced up anymore. The Dow Jones is doing something totally different than the S&P and and Nasdaq. And Nasdaq and Dow Jones almost look like opposites somehow. So maybe the Dow Jones checks back, right? The S&P has a pullback, maybe even a higher low. And maybe, because it's at its trend line, Dow Jones is up here, S&P is around here, and then Nasdaq is, underperforming. Maybe the Nasdaq makes a double bottom, or maybe it even makes a lower low, right? And maybe that's when we see Bitcoin hit like 14K, 15K, because Nasdaq, that tech heavy sector, and then maybe these tech sectors like Bitcoin and all these things, maybe they make a lower low. But in general, the market continues up, all right, and then has a run. And then in 2023, then we see, a double bottom on those tech stocks, and maybe the Dow Jones is just, putting in a higher low or something. Who knows? So it just depends on how deep the recession is and whether or not the Fed has gone so far that it breaks something fundamentally. We don't have to collapse because the Fed doesn't have to pivot, and the Fed has not pivoted yet. So before they pivot, markets can rally because the drop in the market was mostly due to the market pricing in interest rate increases, right? And once the market feels pretty confident, they understand how the rest of the increases are going to go, where they can see kind of the end of the rainbow essentially for the Fed's process. And Jerome Powell has kind of laid out a nice framework that he's operating on. Then you can say the Fed has started to price in almost all of the rate hikes. Now they may be underpricing a few of those things, and so we could see some pullbacks, especially in 2023, especially if inflation starts to come back pretty severely, which could be due to energy, could be due to some type of a famine and food prices spiking, could be due to anything. There's lots of stuff we can't control, like war, right? And so we'll have to find out. We'll have to find out. But it doesn't have to happen. The Fed doesn't ever have to pivot. It can just leave the interest rates high. It just doesn't raise them anymore, right? And so then whatever the market has priced in as a pullback from all of the rate increases, that's the bottom. It just magically becomes the bottom. We don't have to have that ultra low capitulation that all these, YouTubers and guys are talking about on Twitter, which it can happen for sure. It's definitely, it can happen if the Fed does pivot. But if the Fed doesn't pivot, then who cares about that? And the Fed has not pivoted yet. So yeah, now it looks like, we're probably going to avoid the kiss of death in 2022. Going to skirt by with a lot of unresolved issues. Those are going to be left for 2023. And because we're skirting by, the market's really happy about that. You take a look at the VIX. Oops. Take a look at the VIX, and we're basically in heaven for trading. You can see that we have this kind of falling wedge on the VIX here, where at some point it will likely break back up, but until then, we're just falling into this heaven for trading zone, something like this. And the lower we go, especially if we break out of this giant wedge that we've been in, if we break out to the downside, it's going to be really nice trading. We could have a run. If we get into this area, we could have a really nice run. Just like we did back here in these bull run times. Just like we did back here when the Fed was infinitely printing stuff, right? But eventually, we're going to have a major spike, okay? Eventually. Could take months. It could be tomorrow. Nobody knows. Okay, something could break. And even though the VIX is great, right now for trading, that doesn't mean it's a market bottom, okay? Like the VIX being bottomed out doesn't mean that that's a market bottom. That's more indicative of the middle of a market or even the top of a market, right? Because heavenly trading usually happens at the top of the market. It doesn't happen at the bottom of the market. The market should be in hell at the bottom of the market. So why is the VIX acting like we're at the top of the market? Well, that could suggest one of two things. One, either we have a lot further to fall, and that the VIX just kind of looks at us like we're still kind of at the top half, and there's another half to go, right? That would be if the Fed breaks something. We'd get one of these crazy moves that just send us to hell, right? Look at that spike, okay? It happens. It happens, okay? Look at this formation. Look at that spike. These things happen. I've been pointing this out to you for like months, okay? When the VIX spikes, it's either when the Fed breaks something, right, systematic in the economy, or the recession itself breaks people and the markets just bottom, right? So make no mistake about it, the Fed is going to keep pushing to fight inflation for the time being until something breaks, most likely. That's their job. They're trying to get inflation under control. They're likely to keep pushing, and they're probably going to increase rates more than what the market expected, even if they slow down in how much they're increasing, i.e., they haven't pivoted and they're not going to pivot. We're going to be in a high interest rate environment. Tech's going to be a little bit suppressed, perhaps, right? The NASDAQ and the tech markets and crypto, they're just not going to be able to do what they were able to do in an era of low interest rates. The Dow Jones and those commodities, that stuff is ruling right now. The safe bets, right, in the market. It's their time to shine. The Fed printed so much money, it's almost impossible to tackle inflation without them breaking something. So we can look forward to this eventually spiking up. Goes up and down pretty fast. We can look forward to it eventually spiking up. It doesn't hang out at the lows too long. Okay? Yeah, it can go a couple months, but it doesn't hang out there too long. So make your money while you can, essentially. We could even pump through next year. Just be aware that at any time something could get broken and the market will collapse. And these rallies can just dump on your head if you're hodling stuff, okay? Whether it's this month, next spring, 2023, or even the end of next year or 2024. That's why I think it's better just to be a trader, get your capital from your profit and, only accumulate if the VIX maxes out, in my opinion. That's just me. Okay, not financial advice. But not while trading is easy. Historically speaking, people who DCA when the VIX is bottomed make far less money or are even on average in losses compared to those who DCA when the VIX has maxed out. So it feels wrong. It feels opposite. It feels like you should be buying whenever markets are pumping. But but markets are counterintuitive that way, okay? And so is the VIX. Hell is up here, heaven is down here. It's upside down, right? It's bizarro world. That's why people get so screwed by the markets and the rich get richer because they've already figured out the system or they have some advantage on it, right? Their dad knew the system, right? Or their dad's part of the system, you know, one of these insiders, something like that, right? So, if you want to think about it that way, then these ultra elites, right? They're probably buying put options. If you don't know what a put option is, go look up put options, okay? They're not DCAing in, they're buying put options while the VIX is this low. In fact, they may even be coordinating to suppress the VIX so that they can stock up on put options before the market, before the VIX skyrockets because it's just dirt cheap right now to get put options. And they're just going to be sitting in the money when the VIX skyrockets. Whenever that is, this month, next spring, in a year or so. And the guys who DCA, or just hodl during these kind of insane times, historically speaking, they're left holding the bag, while those, elite, quote unquote, masters of the economic universe are just, chilling in their mansions, or by the poolside or whatnot. So I just wanted to have this conversation with you because a lot of people might not understand this information and they may think it's time to DCA, but why would the time to DCA be down here when it's so easy for trading? The time for DCA should be rare, right? It should be rare. It should be short-lived. And it should feel painful. It shouldn't feel obvious. Look how much time we spent down here, right? That's how the market gets bamboozled. Yeah, there's going to be lots of nice trading days. A lot of smart people are going to make a lot of money down here because the trading's just very easy. But the masters of the economic universe, right, they do their DCAs when we're up here. And, we did have a little spike in that area. I mean, we got to 39. Typically speaking, traditionally, over 40 is a great DCA area. But this looks like it's getting pretty close to turn around. And if it does end up swimming down, yeah, I mean, we could have a great winter, great end of the year, great first quarter, and it could go on for a couple months. We could do this little rounded bottom thing right here. But at some point, that's going to break, and it's going to break hard to the upside. It could be one of these, could be one of these, could be one of these. So we'll find out. But for me, I won't DCA for a hold position, a hodl position, right? Unless we're in the hell for trading area. Until then, I'm just going to be a trader. That's it. Just take my profit, put it in my pocket. All right, guys. That's your macro for the day. Stay safe and happy trading.